Let me ask you something, and I want you to really think about this for a second. What if I told you that one decision, just one timing decision, could quietly cost you tens of thousands of dollars over the next 10, 15, or even 20 years of your retirement? No scam, no trick, no fine print. Just a real, honest truth that most seniors are never told clearly enough. That decision is about your Social Security benefits. And right now in 2026, the timing of what you do, and when you do it, matters more than it ever has before. I'm going to walk you through everything you need to know today. We're going to talk about what actually changed this year, what most people are getting completely wrong, and a few moves that could add real money back into your pocket every single month for the rest of your life. This isn't a video full of fancy financial language that makes your head spin. This is plain, honest talk from one person who cares about your retirement to another. So stay with me, because by the end of this video, you're going to understand your Social Security situation better than you probably ever have. And if you're new here, welcome to Retiree's Guide. We cover everything you need to know to protect your retirement income and live confidently in your later years. Go ahead and hit that subscribe button right now if you haven't already. New videos come out regularly, and every one of them is built to help people just like you. Now let's get into it. So let's start with what's actually happening with Social Security in 2026, because there's been a lot of noise out there and not enough clarity. Here's the truth. This year, Social Security benefits went up by 2.8%. That's the cost of living adjustment, or COLA, that took effect in January 2026. Now, on the surface, that sounds like good news, and it is, kind of. For the average retired worker, that 2.8% increase added roughly $56 a month to their check. So if you were getting around $2,000 per month before, you're now looking at something closer to $2,071. That's not nothing, that's real money. But here's where it gets interesting and frustrating, depending on your situation. At the exact same time your Social Security check went up by about $56 a month, your Medicare Part B premium also went up. And it didn't go up by a little. The standard monthly premium for Medicare Part B jumped from $185 in 2025 all the way to $202.90 in 2026. That's nearly an $18 increase. So do the math with me for a second. You get $56 more from Social Security, you give back almost $18 of that to Medicare. You're left with around $38 of real, spendable increase per month. And that's if you're an average earner. For some seniors whose benefit is on the smaller side, that Medicare hike ate up almost a third of their entire raise. This is the third straight year that Medicare Part B premiums have risen faster than the Social Security COLA. In fact, this year the Medicare increase was more than 3 times the rate of the Social Security raise. And people wonder why so many seniors feel like they're running in place no matter how hard they try. Now here is something that almost nobody is talking about loudly enough, and it's one of the main reasons I made this video. There is a brand new tax deduction that went into effect for 2026 that every single senior over 65 needs to know about. It came out of legislation called the One Big Beautiful Bill Act, and it created what many people are calling a senior bonus deduction. Here's how it works. If you are 65 or older, you can now deduct an additional $6,000 from your taxable income. Married couples where both spouses qualify can deduct up to $12,000 combined. And the beautiful thing is, you don't have to itemize your taxes to get it. You can stack it right on top of your regular standard deduction. Now, this deduction does phase out if your income is above $75,000 for a single filer or $150,000 for a married couple filing jointly. And it's a temporary provision. It's set to run through 2028 unless Congress extends it. But think about what this means for a lot of retirees who are drawing Social Security and maybe pulling a little from an IRA or a pension. You could knock a significant chunk of your taxable income down, potentially eliminating or dramatically reducing the federal taxes you'd otherwise pay on your Social Security benefits. For a couple in the 12% tax bracket, that $12,000 combined deduction could save roughly $1,400 or more per year. Over 4 years, that adds up to real money. The whole reason this deduction was created was to help seniors who've been watching their purchasing power erode. And the fact is, the purchasing power of Social Security benefits has dropped by about 20% since 2010. Your benefits are worth roughly 80 cents today for every dollar they were worth back then. So these deductions matter, but only if you know about them and take advantage of them in time. Now I want to spend some real time on what is arguably the biggest timing decision any person approaching retirement will ever make, and that is when to start claiming your Social Security benefits. This is the one that can make or break your financial future in retirement, and I want to make sure you really understand it. You can start collecting Social Security as early as age 62. A lot of people do. In fact, data from the Social Security Administration shows that roughly 23 to 26% of newly retired workers claim at 62, which is the earliest possible age. And I understand why. When you're 62 and you've been working your whole life, and you've been paying into the system for decades, there's something appealing about finally getting something back. The money feels earned, because it is. But here's the catch, and it's a big one. When you claim at 62, your benefit is permanently reduced by up to 30% compared to what you would have received at your full retirement age. That's not a temporary reduction. That reduction follows you for the rest of your life. Every year, every month, every single check. Let me put some numbers on that so it really lands. Let's say your full retirement age benefit, the amount you'd get if you waited until 67, is $2,200 per month. If you claim at 62, you'd receive approximately $1,540 instead. That's a $660 per month difference. Over 12 months, that's nearly $8,000 per year. And every year that COLA adjustment gets applied, it gets applied to that smaller base number, which means the gap between what you're getting and what you could have gotten keeps getting wider year after year. Your full retirement age in 2026, the age at which you get 100% of your benefit with no reduction, is 67 for anyone born in 1960 or later. That milestone was reached this year after years of gradual changes to the program. So if you were born in 1960 or after, your full retirement age is 67, full stop. But here's where it gets even more interesting, and this is the part that only about 10% of retirees actually follow through on. If you wait beyond age 67 to claim, your benefit grows by approximately 8% for every additional year you delay, all the way up until age 70. That means if you hold off until 70, you can boost your benefit by up to 24% above what you'd get at 67. Using that same example, a $2,200 benefit at 67, waiting until 70 would give you approximately $2,728 per month. That's a difference of more than $500 every single month compared to claiming at your full retirement age. And compared to claiming at 62, you'd be looking at nearly $1,200 more per month, every month, for the rest of your life. Now, I know what some of you are thinking. But what if I start getting those payments early and invest the money? Doesn't that balance out? Or maybe, what if I don't live that long? Won't I lose out? These are fair questions, and they deserve honest answers. Here's what the math actually shows. If you live past approximately 78 to 80 years old, delaying your claim to full retirement age ends up putting more total money in your pocket over your lifetime than claiming early ever would. And if you make it to 85, which according to life expectancy tables, a healthy 62-year-old today has a reasonable chance of doing, the difference in total lifetime benefits between claiming at 62 and claiming at 70 can exceed $66,000. If you live to 90, that gap can grow to over $137,000. And that's before you factor in the COLA adjustments that apply to the higher base amount every year. Now, there is no universal right answer here. This decision depends heavily on your health, your financial situation, whether you have a spouse, and whether you have other sources of income to live on while you wait. If you have a serious health condition, if you don't have other savings to draw from, or if you genuinely need the income right now, then claiming early might still make sense for your situation. Nobody is saying delay no matter what. What I am saying is that you should make this decision with your eyes fully open, knowing exactly what you're trading away if you claim early. Because once you file, that decision is locked in. For married couples, the timing question becomes even more important. Here's why. When one spouse passes away, the surviving spouse gets to keep the higher of the two benefit amounts. So if the higher earner in a married couple claims early and locks in a reduced benefit, that reduced amount could follow the surviving spouse for potentially decades. Financial planners consistently say that the single most impactful Social Security strategy for a married couple is to have the higher earner delay claiming as long as possible, ideally to 70, to maximize that survivor benefit. That protection can be absolutely life-changing for a surviving spouse who depends heavily on Social Security. Let's talk about something else that catches a lot of people off guard, and that's the earnings test. If you are under your full retirement age and you're still working while collecting Social Security, there is a limit to how much you can earn before your benefits get temporarily reduced. In 2026, that limit is $24,480 per year. For every $2 you earn above that limit, $1 is withheld from your Social Security benefits. Now, once you reach your full retirement age, the earnings test disappears entirely. You can earn as much as you want, and your benefits won't be touched. But in the year you reach your full retirement age, the limit is more generous. It rises to $65,160 for 2026, and only $1 is withheld for every 3 you earn over that amount. Here's the important thing to understand about the earnings test. Those withheld dollars are not simply gone forever. The Social Security Administration recalculates your benefit upward once you reach full retirement age to account for the months your benefit was withheld. So the money isn't permanently lost. But the timing still matters because the withholding can create cash flow challenges in the short term that take years to work out. If you're still working and thinking about claiming early, this is definitely one of the calculations you want to think through carefully before you file. Now let's talk about Medicare and timing, because these two programs are connected in ways that surprise a lot of people. You become eligible for Medicare at age 65, not at your full retirement age. And here's a timing trap that catches people off guard all the time. You can delay Social Security past age 65 while still enrolling in Medicare. In fact, you generally need to sign up for Medicare within 3 months of your 65th birthday, regardless of whether you're taking Social Security yet. If you delay Medicare enrollment past 65 without having qualifying coverage through an employer, you can face late enrollment penalties that last the rest of your life. Those penalties get added to your Part B premium permanently. That's the kind of timing mistake that keeps costing you money year after year, long after you've forgotten you made it. And there's another layer to the Medicare and Social Security connection that higher income earners really need to pay attention to. It's called IRMAA, Income Related Monthly Adjustment Amount. If your income exceeds certain thresholds, you'll pay higher Medicare premiums. And Medicare uses your tax return from 2 years prior to set those amounts. So what you earned in 2024 affects your Medicare premiums in 2026. This matters enormously for people who take large IRA withdrawals, sell property, do a Roth conversion, or have other income events that push their numbers up in a given year. A single large income event can trigger IRMAA and cost you hundreds of extra dollars per month in Medicare premiums. The good news is you can appeal IRMAA if you've had a major life change like retirement, divorce, or the death of a spouse. But you have to act on it. It doesn't happen automatically. Here's something else that ties directly into timing and that almost nobody talks about at the kitchen table. The Social Security Administration calculates your benefit based on your 35 highest earning years. If you worked fewer than 35 years, the system averages in zeros for those missing years, which pulls your benefit amount down. That means for some people, working even 1 or 2 more years, especially if those are higher earning years late in a career, can actually replace some of those lower earning or 0 years in the calculation, boosting the monthly benefit you'll receive for the rest of your life. It's not just about when you claim, it's also about when you stop working. Now I want to share something with you that I really think needs to be said plainly. There are a lot of people out there right now. Over 10,000 Americans turn 65 every single day, facing these decisions with very little guidance. They get a letter in the mail, they see something online, they hear something from a neighbor, and then they make a permanent, lifelong decision on incomplete information. I don't want that to happen to you. These decisions are too important, and the rules change. This year alone, between the COLA update, the Medicare premium change, the new senior tax deduction, and the full retirement age reaching 67 for a new group of people, there is a lot that has shifted. Being informed is not optional. It is the difference between a comfortable retirement and one spent worrying about money every month. So let me leave you with some action steps that you can take right now to protect and improve your situation. First, if you haven't already, create a free account at ssa.gov and log into the My Social Security portal. In there, you can see your full earnings history, get an estimate of your benefit at different claiming ages, and review your COLA notices. It takes maybe 15 minutes and it gives you a clear picture of exactly where you stand. Check that earnings record carefully. Errors happen, and an uncorrected error could be reducing your benefit right now without you knowing it. Second, take the new senior tax deduction seriously. If you are 65 or older and your income is below the phase-out thresholds, $75,000 if you're single, $150,000 if you're married filing jointly, make sure you're claiming that $6,000 deduction per person when you file. If you're not sure how this applies to your specific tax situation, sit down with a tax preparer or a CPA who works with retirees. This deduction is scheduled to expire after 2028. These next few years are the window to take advantage of it. Third, if you are approaching the age where you're thinking about when to claim Social Security, don't make that decision based on guesswork or what your friend did or what you heard at the barbershop. Model out your specific numbers. Look at your health. Look at your other income sources. If you're married, look at the survivor benefit implications carefully. There are free calculators on the Social Security Administration's website that can show you the projected benefit at different ages. And if you want personalized help, a fee-only financial planner who specializes in retirement can walk you through a claiming strategy that fits your life. Fourth, if you're enrolled in Medicare, don't just auto-renew every year without reviewing your coverage. Medicare Advantage plans and Part D prescription drug plans change their premiums, networks, and drug formularies annually. There may be a better plan out there for you. And if your income has dropped since retirement, as it does for most people, it's worth checking whether you qualify for any Medicare savings programs that could help cover some of those premiums. Every dollar of premium you can reduce is a dollar that stays in your pocket. And fifth, this one is simple but powerful. Stay informed. I know that sounds almost too obvious, but the reality is that the rules around Social Security and Medicare change every single year. Amounts change, thresholds change, new legislation gets passed. What was true last year may not be true this year. The best thing you can do for your retirement is make it a habit to check in on these things regularly, ideally before the end of each year when you're making any financial decisions for the year ahead. That's exactly what this channel is here to help you do. There's one more thing I want to mention before we wrap up. You may have seen or heard talk about the long-term financial health of Social Security itself. The Social Security trustees have projected that the trust funds could face depletion in the early to mid-2030s if Congress does not act. If that were to happen without any legislative fix, Social Security would still be able to pay benefits, just at a reduced level, potentially around 79 to 83% of scheduled amounts. Now, I want to be clear. Congress has addressed these funding challenges in the past, and many experts expect some form of legislative action before any cuts would actually happen. But the uncertainty is real, and it's something worth factoring into your long-term planning. Not to panic, but to be prepared. A worst-case scenario built into your retirement plan is a plan that's prepared for almost anything. The bottom line here is this. Your Social Security benefits are not just a check in the mail. They are one of the only lifetime income streams you have that adjusts for inflation every single year, cannot be outlived, and is backed by the full faith of the federal government. Protecting and maximizing that income stream is one of the smartest financial moves you can make in retirement. And the way you protect and maximize it is by understanding the timing, knowing the rules, and making decisions based on real information rather than assumptions or guesswork. You've worked hard for these benefits. Decades of work, decades of contributions. The last thing you want is to leave money on the table because of a timing mistake you didn't even know you were making. So here's what I'd love for you to do right now. Drop a comment below and tell me one thing about Social Security that you wish you had known sooner. Maybe it's about when to claim. Maybe it's about Medicare coordination. Maybe it's something about taxes. Whatever it is, I want to hear it. Your comment might be exactly what helps someone else watching this video make a better decision. And while you're at it, share this video with someone you know who's either approaching retirement or already in it. Sharing takes 2 seconds, and it could genuinely make a difference in someone's financial life. That's the whole point of this channel. Real information for real people who deserve to retire with confidence. Thank you for spending time with us today here on Retiree's Guide. Take care of yourself, take care of each other, and we'll see you in the next one.